So the plan of the government and the hope of the government is that they can keep kicking the can down the road, and they have always done that successfully in the past. So every time there's a recession or a crisis or a pandemic or a war or a slowdown of the economy, you print your way out of it by basically reflating the economy. The government borrows money, government spends that money, the economy gets reflated, and everybody keeps their jobs. And the plan is to keep doing that ad infinitum. And so far, it's been very, very successful because the rate of inflation has not risen very much. But where the inflation has been seen has been in the price of assets which people use for saving. And by that, I mean, it's whether you look at property prices or equity prices or Bitcoin price. Of course, we know that some of these things are way down at the moment from their peaks. But at the end of the day, step back 10 years ago and look at the price of almost any asset which is desirable and which is in limited supply, and you will find that we've had a significant rise in the price. Not if you look back 1 year, depending on the asset. For example, gold is, I think, probably still higher than 1 year ago, but it's well below the level of the end of January. And Bitcoin also, it's effectively half price now, if you want to look at that. So these, but step back 4, 5, or 6 years ago, or 10 years ago, and you'll find that these assets have gone up by more than the rate of inflation. The reason they rise, or have been rising by more than the rate of inflation, and I think that equities last year went up about 40-something%. The reason they rise by more than the rate of inflation is because people are no longer saying, I'm buying these assets or buying assets other than Treasury bonds to keep pace with inflation. They're saying, I'm buying these assets because I want to hold something which will still be there when we get to the other side of what I don't know what's coming, but something definitely, in my view, could come. Obviously the government plan of kicking the can down the road, continue inflating the economy, asset prices keep rising. That's great until suddenly nobody wants to fund the government. And gold also increased its asset allocation as well. And the reason for that was exactly the same reason. If it went from 15 to, I think, something like 20, 25%, and it wasn't just gold, it was the precious metals sector, which would include gold, silver, alternative precious metals, and gold miners and silver miners. So the exposure to that sector, we saw increasing to something like 20% or 25% even. I can't remember the figure on the spur of the moment. I can go back and check. But the reason was, once again, the prices of precious metals and the underlying had been rising, and it doesn't make sense to sell them at a time when the world is getting more worried about what's coming in the future. We are entering a more dangerous phase when it comes to the debt-based Western government system. We're closer to the end, assuming there is an end. We're closer to the end than we ever were. If we were at 5 minutes to midnight 5 years ago, we're now at 3 minutes to midnight. Understood long before I left the banking industry that we were in a debasement phase. This is something which I kind of learned, I guess, in my early 30s, maybe a bit later than that, but it took a while for the realization to set in what is causing prices to rise. Of course, we all knew the word inflation, and I was growing up in an era in the UK of high inflation. We had double-digit inflation. I recollect in my second job, writing to my boss to complain that my pay rise was only 25% when inflation was touching 30%. Wow! And I felt I should get more, which obviously I solved by changing jobs, because those were the days when you could change jobs and double your salary every time you changed job because of the very high inflation rate. So I was aware of inflation, but I wasn't necessarily aware of what causes it, which is debasement of the money supply, or basically in modern day, printing more money.
The Fed is quietly printing again, calling it plumbing. Government debt is rising faster than GDP. Interest payments will exceed tax revenue within a decade. Clive Thompson says the solution is gold revaluation. Sell gold to the Fed at $15,000 per ounce and buy it back with gold notes. This would reduce debt, lower yields, and kick the can further. AI bubble is overvalued. The sector is spending $1 trillion per year with only $50 to $60 billion in revenue. A NASDAQ correction is coming. Gold and Bitcoin will both recover, but Bitcoin will outperform. He owns both.
It would make a lot of sense. The government has done similar exercises before in 1934, on the 31st of January 1934, and when it revalued gold in 1974, when it pushed it from $35 to $42.22. And basically, when you revalue gold, you're creating money out of thin air. Now, there was slightly different exercises back then, but the principle is the same. But the way it would work this time around is through what's called a sale and repurchase agreement with the Federal Reserve. So the government has the gold. It belongs to the government. The reason it belongs to the government is they basically did a purchase of the gold, a forced purchase from the Federal Reserve back in 1934. So back in 1934, the Federal Reserve had all the gold, and the government said, whether you like it or not, we're buying that from you at $20.22 an ounce, and you're going to give us the gold, and we're going to give you something in exchange called gold notes. The thing about gold notes is they don't represent gold, they represent dollars. They are irredeemable. The Federal Reserve may not redeem them, except if the government decides to do so. They bear no interest, so they are perpetual, and they're not part of the government debt. So all we do is effectively repeat that kind of exercise in a slightly different way, sell the gold to the Federal Reserve for today's market price, or more likely a much higher price. I'll come to that in a second. And immediately buy it back from the Federal Reserve for gold notes, which means that the government keeps the gold, gets to keep the gold, and has a whole bunch of money for the sale of that gold, whilst issuing an exchange, a piece of paper which is worth absolutely nothing. It's a bit like a banknote, if you like, worth nothing. Just a bit of paper. The Federal Reserve can't then turn around and say, give us our money back. But they can, from an asset and liability point of view, treat it as an asset. So even though these gold notes that they hold at the moment, in theory, are worthless because it's a perpetual zero coupon. What's a perpetual zero coupon worth? Worth nothing, like a banknote. In theory, it's worth nothing, but they're treating it on their balance sheet as an asset. So let's repeat the trick. I mean, when I say let's repeat, I think it would be a great idea to repeat the trick. Sell the gold to the Federal Reserve, immediately buy it back. The Federal Reserve prints the money, pays it in cash to the government. They've got the cash now. Then they buy it back, but with the gold note, not with cash. So now they keep the cash and they keep the gold, which means that whatever cash they get in can be used to fund the current year's deficit. And that would generate $800 or $900 billion, not enough to fund the current year's deficit in full, only about a third of it. But if they did a much higher price, and I've suggested perhaps $15,000 might be a good price to choose, because by using $15,000 per ounce of gold, the government would collect several trillion, enabling them to not only fund the current year's deficit, meaning that as they spend money, they wouldn't have to borrow it, but secondly, it means that they'd have a surplus left over beyond this year's spending, so they could, as bonds start to mature, and there's bonds maturing all the time, they could retire these bonds with the cash they've just got from the Federal Reserve without needing to borrow money to roll over. So what's been going on at the moment, we've been borrowing from Peter to pay for Paul. So every time a bond matures, they borrow from someone else to pay back the person who's just got a maturing bond. They wouldn't need to do that. What would that mean? It would mean that the national debt would start to shrink slowly over the next 12 months, 18 months maybe. So the national debt would shrink a little bit. It wouldn't go to nothing. It would go to, let's say, from 39 trillion to 37 trillion or 38 trillion. It'll go down a bit. Meanwhile, as this is happening, the economy continues to expand. So GDP continues to rise. The debt is going back down, which means the debt to GDP ratio of the government starts to go lower, which is something that hasn't happened in decades. But a lower debt to GDP ratio makes the whole system a lot safer, and therefore it can last a lot longer. If I look at the AI sector, the data center sector, the semiconductor sector. There's an awful lot of money flowing into that sector. And it's an area where the cash flows from end users aren't actually currently sufficient to pay the electricity costs. On top of that, there's all the capital costs going into the sector, probably something like 10 times the electricity cost, so 10 times what people are paying in is going in annually in investment into trading the AI tools, into buying them the chips, the NVIDIA chips and others, and going into the data centers. So that money going in, that capital expenditure is set to increase for the next few years. I hear that it's going to be 800 billion this year. Next year, it's going to be $1 trillion. The year after, it's going to be 1.2 trillion. Whereas the amount of money coming in from investors into that sector is something like 50 or 60 billion in terms of fees that people are paying. And the electricity costs are higher than that already. So the question is, will the amount of money being paid into that sector, that broad AI sector, increase sufficiently to make those investments, those $1 trillion a year investments, worthwhile as investment for the companies which are making those investments? I have my doubts. I think that down the line, of course, the AI sector is going to continue to expand massively, but and they'll think of all sorts of new things to extract money from the end users, such as advertising, such as on-selling agents and all kinds of tools. But there's probably some sort of limit as to how much can go into the sector. And I don't know if it's going to be, I don't quite know where the figure lies to justify the $1 trillion a year investments which are being made. But my view is we're not going to get there, and therefore there'll be consolidation in the sector. There'll still be new arrivals who are undercutting the others. It'd be hard to put the prices up because of the competition, because of overcapacity. I think that means that the profit expectations for these companies, for the entire sector, will not be as high as people are currently expecting. Yes, there'll still be massive growth, but it'll be massive growth minus X, whatever X is, because of the overcapacity. And therefore, the share prices of the companies which are involved in the sector will probably not be as high as we are currently expecting. Therefore, I would say that there's a danger that NASDAQ comes off quite a bit. So at the end of the day, when the government prints, it basically is buying assets with that money it prints, which is government bonds. And that's the end. That's the bottom line. And why are they buying government bonds? Because it keeps the yields in check, making it easier for the government to borrow money. That's it.
And I mean, but where is this money? Like, they're not. Are they saying this out loud? Does everyone know that they're? And what is this? What is the amounts that they're buying back right now?
So doing it very quietly. I haven't got the figures in front of me, but they've turned around for what was called quantitative tightening. Quantitative tightening was where they were reducing the size of their balance sheet. The balance sheet for some time now has been increasing again. So as the Fed's balance sheet gets larger, there's two sides of it. The asset side gets larger and the liability side gets larger. The liability side basically is the new money they're printing at the moment, and the asset side is what they buy with that money. Now, whether they are holding bank as assets, whether they're holding bank deposits or government bonds, the bottom line is that money is finding its way into the government bonds and suppressing yields. So by suppressing yields, it does make it easier for the government to borrow money at an acceptable rate. We don't know where the crossover point it lies for it to become unacceptable for the government. Nobody can tell you that, but I would guess that the government's not willing to borrow money on the 30-year level at more than, say, 5.5%. I don't think they want to borrow money at the 10-year rate at more than 5. So we can guess whether that's where there's a mental limit for the government for the central bank to say, well, every time we see rates going above that, we'll start to pump money into the economy to make it easier. But of course, there's a quid pro quo there. If you pump too fast and too much, then people start to say, the inflation's increasing, inflation of the money supply. Therefore, I'm going to be less willing to buy the government bonds. So it's kind of a balancing act. It's between the devil and the deep blue sea. You can't do too much of it, but you can't do too little of it.